Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is my co-host, Yahoo Finance senior reporter, Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about all things ETF. From plain vanilla stocks to their leveraged cousins, to commodities like gold and silver, to more advanced products using derivatives, the kind Warren Buffett calls weapons of mass destruction. Our phrase of the day, market concentration. Just because we've got lots of participation doesn't mean you don't own too much Nvidia. And for market show and tell, we're looking at a large cap energy ETF exploring the concept of trading ranges. As they say, the longer the base, the higher in space. What that means for your energy plays. And this episode is brought to you by the number 13. When we look at leverage ETFs, that's how much more the ETF crowd is long versus short. We're going to tell you what happened the last time we hit these eye-watering levels of bullishness. And today we are welcoming back Todd Sohn, CMT. That stands for Chartered Market Technician. So we're going to be digging into some voodoo technical analysis. He leads ETF research at Strategist, where he works with institutional clients, and he writes some of the most innovative and actionable ETF flows reports in the industry. That's why we've dubbed Todd here the ETF Whisperer. Before we get into market concentration, Todd, set the table for us in 2026. What are we walking into?
Okay, so I think 26 is about, we'll talk about concentration.
Yes.
Participation, right? How many stocks are in on the move?
Breadth.
And sensation. How bullish is the crowd getting leading into this year? And listen, it's a global bull market. Things are in still pretty good shape, but I have some concerns about the third part of that, the sensation. Folks are getting
And what does your rumination lead you to say?
There'll be a speed bump.
Yeah.
The setup is eerily similar to the start of 2025, right? Coming off of a really great year. The backdrop of earnings and margins still really strong, but folks are going to get very bullish because of how strong the markets have been in the equity space. So I would not get too deterred. I don't want to sound bearish or anything like that. I just would be mindful of the potential to get tripped up at some point in the first half.
Let's stick with one of the phrases that you mentioned with our phrase of the day, and that is market concentration. That's when a small group of big stocks drive a huge chunk of an index or your portfolio. So you can have broad participation and still be overexposed to one or two names. As Jared said in the intro, just because lots of stocks are up doesn't mean you don't own too much Nvidia. And Todd, this is something you've really been focusing on recently, even saying that investors perhaps are forced into market concentration. So just walk us through that.
I think there's a confrontation with concentration ahead for investors, right? This does not mean that it is a lack of market breadth out there, right? You have 10 stocks that make up 40% of the S&P 500. That is multi-decade highs. That's been the story of the last year and a half. Defensive sectors in the S&P 500 are at a 35-year low. That's energy, healthcare, staples, utilities. They're only about 19% now. And so whenever you are buying an ETF, a large cap passive ETF, you're going to be allocating $40 out of 100 to those 10 stocks. It's the same thing if you're buying large cap growth, if you're buying an AI thematic ETF, or even momentum and quality. They all own stuff like Nvidia, Microsoft, Apple, Amazon. That's greatly benefited everyone, but I think now is a great time to say, hey, how much of this do I actually own? Because there's so many other opportunities abroad. Right.
We're going to get to that in a second. I love all the opportunities that you've laid out in your most recent report. I want to get to that level, that number you just mentioned, 40%. That is the market weight of the 10 largest stocks in the S&P 500. You said, is it going to, you wondered aloud, is it going to go to 50% or 30% first? And just kind of walk us through that one.
That is a very important question. If you go to 50%, right?
That's huge.
You're getting more and more concentrated. Clearly, that means AI.
We're going to call it the Nvidia 500 or something.
Yeah, exactly. and that probably starts to bring in some sort of benchmark rules too, right? There are rules, regulated investment company rules that say you can only have a certain percentage of your assets in a certain amount of stocks. That's a whole other category. If you went down to 30%, that means passive indices are probably going through some sort of hiccup, right? Maybe the earnings disappointed. But other areas are likely picking up steam. Maybe it's healthcare, maybe it's industrials or staples, for example.
Yeah.
So there's a lot of implications on what gets hit first. Now, the one I didn't mention in that sentence and that you didn't mention is what happens if we just stay at 40? Well, okay, that's fine too. That's status quo, which I don't mind, but I still think investors need to realize how much of the ingredients that they have in their portfolios.
Todd, I really like the way you phrase it. You said that we're at this point of confrontation for concentration. So for investors who are looking at their portfolio right now, what are some indicators they should be looking for to realize I'm at a confrontation right now?
Yeah, well, just take a look at, say, do I own the S&P 500? Do I own large cap growth? And then do I own a thematic fund that has a lot of tech in it? They need to do a deep dive. And there's software out there. There's people like myself that can help and say, well, hey, what's in my portfolio total? And then do I own international? Do I own small caps? Do I own alternatives out there to help kind of water down and dilute that exposure just in case you're going to need it at some point?
Just in case.
Yeah, you need to have insurance out there, right? Because you have benefited from large cap growth and AI, especially over the last couple of years. But too much of a good thing can be harmful at some point.
Let's talk about some of those names, some of those new ETF tickers, and maybe not all of them are new, but that offer alternatives. And I would note that I've become a prize thanks to your work to buffer funds and their popularity. And that's basically, if the S&P 500 goes up 20% this year, you might be limited or capped at 10%, but also your downside is capped. That's just one example. And that's just one tiny slice of the ETF market. So tell us about the options that exist out there.
There are so many. There are so many. And it all depends on the type of investor, the demographic, right? Your age can be very important for buffer ETFs. Right? They give you downside protection, say up to 20% of the S&P or the NASDAQ. And if you are maybe closer to retirement or you're about to make a large purchase, a home, a car, whatever it might be, that buffer fund can help you if you're nervous about the market taking a very large hit in the near term. The other options, you can buy a covered call fund where I'm going to sell options against an index to generate income. There are things like managed futures, which I know are near, I think, dear to you, Jared.
Yes.
I love those because they can be crash protection in a sense, right? If the market were to take a hit, maybe some other areas such as commodities or fixed income get a boost, and that's where that managed future space can offer you lower correlated returns. That's the key word here.
Correlation, low correlation.
Looking for low to uncorrelated ETFs to fit into your portfolio to balance out U.S. equities.
So it takes a little bit of research here. All right, we got to get into today's market show and tell, and we are looking at trading ranges today. And we're using the S&P Select Energy Spider Fund, ticker XLE, as an example. So a trading range is when price bounces between a floor and a ceiling for a while. It's not trending up or trending down, it's coiling. And XLE has been in a big trading range going back about 3 to 4 years. But if you max out the chart to the ETF's inception at the very beginning of the century, we see that this is the third time that XLE has tried to break through that $45 to $50 area. So it tried in 2008, in 2014, and it pretty quickly crashed down each time. And now that XLE has spent about 3 years consolidating under the $50 level, I got to think, well, if this thing breaks, as Ralph Alcampora says, the godfather of technical analysis, the longer the base, the higher in space. So what do you think about this one?
I think energy is super interesting. Okay, so the risk is opportunity cost. Energy continues to just be nothing, right?
It could be in a trading range another year.
A year, 2 years. But this goes back to the concentration aspect. If you're looking for something different and lower correlated, energy makes a lot of sense. And I think this is a great risk reward for if you're a more tactical investor to buy XLE for playing for that upside for that breakout. Or use the options market. If you understand the options market, buy a call option to say, all right, I'm going to limit my capital, but I'm going to buy a call option out in the future to play for that breakout. And I like to put on my technical hat, big trading ranges, because you have very defined risk. Once you break out, you're good there. If it breaks down, you're out, right?
Yeah.
Very much defined. It's just more about the waiting game.
Yeah.
But energy is the one that's been on our radar.
When you think about the overall rotation that we've seen within this market, utilities, industrials, materials really gaining momentum, what do you make of that? And maybe when you're thinking about XLE as well?
So industrials are all about power and defense, right? Power because of the AI story, and then defense because we have these geopolitical events such as Venezuela that just happened popping up. And you see that there is demand for these companies. So industrials have been a beneficiary of that. And there's a lot of industrial defense ETFs out there now. Energy, to me, is one way to play against and this is a big if inflation were ever to come back, right? Can oil ever revive itself? Who knows, right? We'll see. But that's one way, along with defense, and metals and mining to play against a second wave of inflation. If that ever happens, we'll see. It certainly doesn't seem like a problem right now, but if it's a low bar for oil, you ever get WTI oil back above 70, 75 bucks, then you can start to say, okay, that should benefit energy there. And it's also not very crowded. I look at sector ETF flows, and there's been a ton of money out of energy because it's been so frustrating.
Yeah.
So I like that from an interesting contrarian perspective.
I want to ask you about another sector. I think it was a year ago, we were talking about healthcare, and healthcare really came alive at the end of 2025. You were talking about the opportunity, and it hadn't set up quite yet. Technically, I mean, the price bottom was not quite in yet, but we had seen those negative flows, and it was so unloved. And at some point, it just had to pop, and it had to click, and it finally did. I wonder if you still like healthcare.
Yes. Do I think it's getting a little bit more crowded and leading consensus? Yes, but it has momentum, and it has the trends are back now, so I don't want to fight that. And there's still a lot of names in healthcare, whether it's big pharma all the way down to super
Eli Lilly just hit a record high
exactly.
time in a while.
And that took a good second half of the year off. So from Eli Lilly to high beta biotech that have been off the playing field for the better part of the last 5 years. Think about it that way.
Yeah.
So you had the setup, the statistical extremes for healthcare, the really bad performance, the outflows, and now the full market embracement's coming. So I still think healthcare is worth it, especially in the concentrated world. I'm very much enthusiastic on that space.
I will definitely keep a close eye on healthcare, but we do need to take a quick short break. But coming up, we're talking leveraged ETFs plus a Disney-inspired runway showdown. Stay tuned. This episode is brought to you by the number 13. In leveraged ETFs, that's the rough gap between how much more the crowd is positioned long versus short, about 13 leveraged long dollars for each short dollar. Todd, you tracked this ratio over time, and what caught us within your report and your work is that the last time we were at these levels were late 2024, early 2025, which is right around the time that U.S. stocks were peaking, a few months before things really did melt around Liberation Day. Then we sort of started to turn in the market. So tell us where we're at now and what you think is going on to kick off this year.
Yeah, it's very similar, right? We're at new highs. We have big flows in equity ETFs. And the great part about ETFs is I can get little clues on how investors are behaving. One of those ways is through levered ETFs. Take the ratio of levered long funds to inverse ETFs. And that's a pretty good and kind of new sentiment barometer. So we're at a new high on that, as you mentioned, 13-1. It is not a sell signal, but more a situational awareness that, hey, people are very enthusiastic right now. If that is met with deterioration from market breadth, that's when you start to raise your guard and say, hey, well, are we going into some sort of environment like we saw from March to April last year? I just want to be very cognizant of that there's a lot of use of leverage from the everyday investor.
I want to hit on that because we are in the second era of leverage ETFs, because I've seen charts going, and they might have come from you, going all the way back to like the mid-aughts, so like 2005, 2006, and there was a rise. So in 2007, 8, 9, 10, even 11, we saw all these levered ETF products, and those were the first batch. But I think what killed them was the flash crash, and then we had, we had some tough markets back then. Liquidity was a big issue. A lot of big players went out of business, and then recently we saw this resurgence. And as you noted in your work recently, 1 in 4 new listings for ETFs in 2025, they were levered. Does that give you any kind of concern about things overall?
Yeah, what's your indication here?
It makes me a little nervous. Leverage is, when not used properly, very dangerous, especially for folks who don't understand what they're getting involved in, right? You don't buy a 2X or 3X ETF and expect it to hold it. It's meant for day trading, right? But there is this pervasive amount of launches using leverage, especially on single stocks now, and those are getting more and more volatile. If the U.S. were to ever enter some form of a bear market, a lot of that will disappear, I suspect, right? The bull market in U.S. stocks have kept the leverage space alive for quite some time.
People are willing to take on that risk.
Yeah, exactly. This is all about risk. This is totally all about risk. So I think it's something to be aware of. It's not a case to say, all right, sell all my stocks. You don't want to do that. But if you're just looking for the bear case or the risk case in the near term, it's this levered space that's going on, the activity there. And you're seeing the trading volumes too. They're skyrocketing.
You hit on something I want to expand on for just a second. We did an entire show, an entire segment a few shows ago on leverage ETFs. That was our phrase of the day. And what you pointed out just now is that these are geared towards day trading. When they say 2x or 3x, they are doing that on a daily basis. So not over a month. So if Tesla goes from, if it 2x's over a month, you're not necessarily going to get that in the levered fund. In fact, if Tesla achieves that doubling of its price, but in a very volatile way, you can lose money even if you're in the 2x ETF. So just kind of talk to us about that dynamic.
Yeah, so they have a daily reset, right? Every day they have to reset the exposure from whether if the stock goes down, it might go below 2x. I got to bring it back to 2x or above, bring it back to 2x. There's also fees involved here. These are expensive products. They're expensive in terms of the management fee and then the fees to get the swap exposure. And as long as interest rates remain somewhat higher than they were in the QE era, which was nothing,
right?
It's going to cost you to get that swap exposure. So the fees will eat away at your returns each day. I think that's an important part of this too. And then also volatility, right? Whether it's Tesla or any other name out there, if it goes down 20%, that means the 2x is going down 40%. So you're already getting crushed there. There's a lot of cards stacked against you when you're trying to hold these for longer than a day or two. And so you have to be very, very mindful of that. They're great when the market gets some momentum, especially coming off of the correction lows. Think of March 2020 or even April 2025. That's when the leverage really picks up because people want to press their bets in a liquidity environment. But again, they're just not. You have to read the fine print. I think that's so important. A lot of folks miss that because no one likes reading fine print.
Todd, we did get an interesting stat out this Monday. The stat says that $700 million worth of inflows into U.S. Bitcoin ETFs happened on Monday. That was the most since about October 7th. When you think about more and more firms willing to go into these Bitcoin ETFs, what do you make of it? And maybe we're hearing about this risk-on environment. So what's your...
Do the flow? Yeah, let me broaden that. Do the flows predict a bottom in Bitcoin? Because everybody wants to know if there's a bottom in Bitcoin.
So flows to me aren't necessarily a signal, but what is super interesting, Brooke, you mentioned that allocations are being opened up by large firms.
Right.
Vanguard, Bank of America, Morgan Stanley filed for crypto products this week, their own. That is a massive amount of money, of U.S. wealth to buy Bitcoin products. And so it makes you wonder, advisors have had access to U.S. stocks, international stocks for years, and that's money going in every single day. Is that now going to translate to crypto and kind of keep the bid afloat for crypto products? Of course, it's not going to work every time, but there's so much money now being opened up to that space that I wonder if you're putting in a bottom because of that, right? I was a little deterred by how much random crypto products were coming out of the ETF space recently, 2x, Dogecoin, and stuff like that. Like, okay, you can have fun with it, but it's hard to take too seriously. But it goes back to this wealth channel that's now being opened up to a relatively new asset class.
So it seems like proceed with caution kind of take?
I think if you want to take a flyer on Bitcoin, it can be worth a shot here in a tactical sense. And I also think that if you have FOMO and you don't want to miss the next big rally, whenever that is, having 1 to 3% seems to be what everyone agrees upon in a portfolio. And now you can buy it in ETF, safe. You're not going to wake up and have zero unless the price declines. You're not going to get robbed like you would in a wallet to some extent. So I think worth a look, and keep in mind there's a lot of money coming to the space to help probably keep prices afloat.
Before we get to our runway showdown, I'm wondering, anything on ETFs that we didn't hit on here just yet that you think is important for the viewers and listeners?
Let's see. So I think take a look at small cap ETFs.
Okay.
2025 was the first time since 2011 that you had outflows from small cap ETFs. And
right.
There's a few
and we saw new highs in, IWM
they
and
are
Russell
back.
2000.
They are definitely back, right? There's a lot of healthcare in small caps that's working, and there's a lot of financials that are working in small caps.
I think it's the biggest sector.
Yeah, if you gave up on them, up your dosage, come back into the space. So that's rare. And we're also at this point, we talked about buffers. Derivative usage is really escalating in ETFs. Just do your homework when you're looking at one of these products because they're very complex. They can be a really good solution, but they're not just all right, I'm just going to buy it. Make sure you understand what you're getting involved in.
Again, read the fine print here. Not everybody's cut out for it, but that's why we have advisors. All right, now we've got a market's take on a classic Hollywood gab show staple, Who Wore It Better? And today we're pitting physical versus digital gold, but with a twist. We're going full Disney, as Todd here is a huge fan of the franchise. So on the left catwalk, we've got Scrooge McDuck, who we all know loves his gold. He's strutting in a velvet banker coat with metallic gold trim, coin cufflinks, and a solid gold cane. The style is pure store of value, heavy, classic, built to last. When markets get weird, investors like their bullion, and Scrooge, he likes to wear it. On the right, we've got Buzz Lightyear repping Bitcoin and outfitted for infinity and beyond, which means to the moon in Wall Street bets parlance. He's decked out in a glossy spacesuit jacket with neon edge glow, chrome accents, and a rocket pack that screams crypto liftoff. So Todd, who wins the 2026 return race? Is it Scrooge McDuck and his gold trade, or Buzz Lightyear riding the Bitcoin juggernaut?
I love that.
Ooh.
That's fantastic. if I'm picking right now, I will skew towards Bitcoin. I think there's a little bit of metal mania. Actually, not even a little bit, a lot of metal mania going on right now.
So too far, too fast.
Yeah,
the underdog.
Too late as well.
It's hard for me to want to chase gold, silver, and you're even seeing like platinum, palladium really take off. And you see it in the activity, you see it in the inflows, really esoteric, levered metal ETFs are seeing massive volumes. I don't love that. It's very frantic to a sense. And gold's been on a great run, but there's way too many statistical extremes there for me right now. If it resets, then we can revisit it. Meanwhile, the reset has happened in crypto, and I think that's far more timely. As much as if you're looking at charts of the two, most will say, well, gold clearly has the better trend. But I think crypto is far more timely.
What do you make of the current trends that are happening with all these firms, like we just discussed, getting in? Do you feel like that's the opportunity as well?
Absolutely.
And so we had many gold guests on the show, and they say, okay, if we're going to play gold, play into ETFs. But you're saying maybe move away from that and because gold's seen at the safe haven here, Bitcoin a little more riskier.
The risky safe haven. I love it.
Crypto is definitely more risk on. I think gold seems to work almost in any environment. It can work in risk on, it can work in geopolitical risk off, and inflationary risk off too. But I look at this as purely what is more timely for a new allocation. And crypto has corrected a meaningful amount over the last
down
6
from that
months.
$126,000
I think folks, as much as it's being opened up to the advisory community, kind of moved on to it. And you see all the trading volume going to the metals right now, and it's very frantic. And a lot of call activity, a lot of inflows, tons of volume, and anything with metal on it, seeing super action. And I don't love that. I never like, because that tells me the herd is involved there. And
just waiting for that Time magazine cover featuring gold or something like that.
Or that's probably on the way if it already hasn't happened. So I never like when that starts. That makes me very nervous.
I hear you. Well, Todd, it's been a pleasure having you back. Again, this is your 5th time here. So if we had a bigger budget, we'd get you a mug or a letter jacket, something.
I truly appreciate it.
All right.
I love doing it.
And we learned a lot here. We started with market concentration. And just as a reminder, Nvidia and the 9 other largest stocks in the S&P 500 taking up 40% of it right now. And Todd's big question, does it go to 50 first or does it go to 30 first? And those particular scenarios have huge implications for what actually pans out in the market. We're going to have to wait and see exactly how it shakes out. But in terms of trading ranges, I've been looking at XLE for a while, and I could be looking at it trading sideways for another year here. But when it takes off, I think it's going to take off for a while. And on levered ETFs, you got to know what you're getting into. These are for day trading. If you're trying to make a long-term bet on Tesla, you're better off probably doing it in another way. So we have officially wound things down here at Stocks in Translation, but make sure you check out all our other episodes of the video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to leave a comment, and subscribe wherever you get your podcasts. And we will see you next time on Stocks in Translation.